Alright, thank you everyone for making it today. If you can please take your seats, we're going to get started on the Alright, ladies and gentlemen, ski miners and friends of BTAC, welcome to an enlightening workshop on venture capital. Brought to you by the UTEC Mike Loya Center for Innovation and Commerce in collaboration with Water Ventures, a venture capital firm based in El Paso, Texas. My name is Fernanda Fiscal, director of the Mike Loya Center, and I am delighted to accompany you on this learning journey throughout today's workshop. Today, we are embarking on a journey to uncover the secrets of venture capital with none other than Alejandro Muñoz-Mendieta, co-founder and managing partner of Water Ventures. Before we delve into the world of investments, let's extend a warm welcome to our university leader and advocate of entrepreneurship and innovation here at UTEC. Please join me in welcoming Dr. Wilson to the stage for her welcome remarks.
Fernanda, thank you. Thank you for all of your work with the Launchpad and with the Mike Loya Center. We are fortunate to have the Mike Loya Center on campus to really help put some focus on entrepreneurship and innovation. But we're also really fortunate to have alumni and people who are associated with our university to help us along the way. And we occasionally, we've now, one of the great things is when people come back to the community and they've done a lot of really interesting things, we say, I really think you should be adjunct faculty. And we prevail upon them to help us. One of the things that's hard about thinking about your startup is, all right, where does the money come from? Right? It's not, and in a lot of our cases, so I have in my life started 2 companies. My son has also started 2 companies. His have been much more successful than mine. But when I started my first company, it wasn't like my parents had the money they could give me, right? How do I do this? How does this all work? And for me, I was not a capital-intensive company, either one was. But I learned a lot. I'm also, because I'm of Scots heritage, I think I'm also really cheap. I didn't want to borrow money. I didn't want to take money from somebody else, right? I wanted my company to be my company, and we grew organically. But a lot of companies, you can't do it that way. In order to go, particularly technology companies or software companies, you can't scale fast enough without investment. So the great thing about money is that it moves. It doesn't have to be located right here. It can come from anywhere, really. And we are now really blessed to have Alejandro here in our community who understands this world and can start to share it with all of you on how does venture capital really work? And how might you start to be thinking about it? How many of you have already started your first company? Yeah. How many of you have in your head the next one you want to start? Yeah, that's why you're here. And we want to be helpful to you, to connect you to opportunities, to resources, to ideas, to learning, so that dream that you have maybe gets a little bit bigger. So thank you. I look forward to what you have to say with us this evening, and thank you for agreeing to do this. We really, really, really appreciate it.
Thank you, Dr. Wilson, for your words and for being here today. Now, let's shift our focus to the hearts of today's discussion. Join me in welcoming the driving force behind the Venture Capital Workshop, co-founder and managing partner of Water Ventures, Alejandro Muñoz.
Thank you so much. Well, first of all, thank you to President Wilson for those kind remarks. Thanks to Fernanda, to Christian, to Michael, and the rest of the team, the Mike Loya Center, and the Launchpad for putting this together and offering this invitation. I'm really excited to be back home. This is for me, everything started here about 15 years ago, and it just feels great to be able to share a little bit about my trajectory, and hopefully this will be informative for some of you and help you in your journey, whether it's as entrepreneurs or as investors. So let's get to it. Quick disclaimer, no venture capitalists can go without this, right? So quick disclaimer, this is informative. I want you guys to learn. I'm not selling you anything, and I'm here to be a guide and to support you. And if you have questions later on about other ways of investing or thinking about venture capital, happy to talk to you and go through that. So today's agenda, and this is going to be jam-packed, so I might be talking a lot, but I'll definitely take some Q&A towards the end. And I'll actually be sharing these slides with you folks, so don't get too caught up in the details. I'm going to try to go through as much of this as possible, and hope you'll have this as a resource down the line. So I'm going to talk a little bit about the history of venture capital, how we got to where we are today, talk a little bit through the phases and how venture capital has developed, and also teach you how you can invest in startups. Whether you're, a lot of people think that it's impossible, but there are actually ways that you can do that. So, I'm not going to spend too much time on me, but as I mentioned, the most important part about this is I'm a UTEP alum, and I've been in the tech space for several years now, both as an investor and also as an operator. So for the most part, I think I've gone through the struggle that a lot of you, especially those that are entrepreneurs here, I've gone through the same thing that you've gone through. So when people think about venture capital, people tend to think about it as something esoteric, right? It's not very much available to folks. And really, to start to demystify what venture capital is, it's an asset class. Same as the money market funds that you might invest in, the bonds that companies issue, or the stocks that you invest in, whether you have a specific portfolio or through your fund managers, through your wealth advisors. Venture capital is the same. It's another asset class that people can invest in, and it has a very high risk. It ranks really highly on the risk side, but then it also has a really high potential for returns. So basically, it's an asset class that is mostly used to invest and support, as Dr. Wilson mentioned earlier, high growth and high potential startups, high potential businesses that require a lot of capital to scale and to be able to really change the world or change industries. The purpose of VC, of course, fuel innovation, and some folks that invest in this use it to diversify their portfolios more than anything. Now, quickly highlight, why is it high risk? Well, 80% of startups fail within the first 5 years, and very few companies are the ones that survive and that generate all the returns for any investor. So, very high risk. But also on the return side, actually VC in dark green compares very well with other asset classes, right? So your typical equity portfolio, which will probably generate about 10% on average historically, VC actually outranks that asset class by a lot, right? But of course, it's very high risk. You have to choose your battles, pick your battles very well. What's the big deal about venture capital is that the big behemoths that we know today, all the big technology startups that we know about that are now public, that are leading change and leading the world of innovation, they all went through the venture capital method of investing, right? They received, someone believed in their initial idea, they gave them the initial support to start operating their business, and over time they proved that they were able to create a really great business model that has created a lot of economic impact and many times even changed industries completely. So I'm going to go through a quick history of venture capital for you folks, but venture capital has been around for a very, very, very long time. So actually it all started with Queen Isabella and Christopher Columbus. When Queen Isabella funded Christopher Columbus so he could go out in search of the New World, she gave him basically the task of go out, find a lot of gold and bring it back here. I'll keep 90% of that, you keep 10%. And that's what happened, right? Christopher Columbus found the West Indies, and the gold rush of that era began. Later in the 1800s, whaling became very important for whale oil and to develop candles. It was very difficult to catch these whales. So folks decided, yeah, I'll put up money so you can go out into the ocean, find these whales, and I'll keep 80% of the profits, you keep the other 20%. And that's how the method of the 80-20 split when it comes to venture investing came about. So this has been around for a long time. Then one of our major angel investors, one of the most prolific investors of our time, JP Morgan, he funded Thomas Edison in his battle with Tesla. He actually installed about 400 light bulbs in his home to prove to the market, prove to the world that Edison's invention worked, and that over time gave way to General Electric, which was one of the first 12 companies to be listed in the Dow Jones Industrial Average. Now, leaving the old age and going into the 20th and 21st century, 1946, Professor George Storia from Harvard Business School, he decided to put together the real model for venture capital, the one that we know today. He asked companies, he asked universities, endowments for money to support his efforts. And he invested in this tiny company. He invested about $70,000. A few years later, that company was sold for $355 million. So huge return, and that gave way to the venture capital industry that we know of today, right? So all the people that worked with him, all of his students, they went on to Silicon Valley, and they created their own venture capital funds. And that later on created the internet bubble. So in the early 1990s, a lot of great companies like Yahoo, Netscape, Google came around 1998, but a lot of these companies were founded, and in 2001 we had a big bubble that burst that is very akin to what we saw in venture capital recently, and we'll get to that in a second. But the great thing about bubbles is that once they burst, they create opportunity for innovation, and very great founders that are resilient, that can bootstrap, that can do more with a lot less. And that gave way to the new wave of entrepreneurs like Netflix, WhatsApp, Facebook, Airbnb, Uber, etc. Nowadays, in the 2020s, it seems like we're going into the wave of AI and artificial intelligence. Now, this is looks like a very boring graph, but it actually tells you a lot of history, a lot of really important details. And look at this. There's a bubble here. All of a sudden, this is how much money was invested in startups on a yearly basis. What happened in 2021? And now, why has it come down substantially over the last couple of years? And let's look at this. It all started in 2018. 2018, we had a very robust economy. Very robust economy where we were growing at the fastest pace since 2005. Unemployment was very low, the lowest it's been in a very long time. And so when things are good, people take risks. People take risks, and hedge funds that typically hadn't entered into the space of venture capital, they decided, I'm going to invest in startups. We're going to invest in startups, even though I've never done this before. And same things started to happen with folks like typical investors, market investors. Crowdfunding opportunities became available, and we'll go into more detail later on. But these became available, the SEC passed regulation, and so that started to increase the amount of money that was invested into startups. It's followed 2020 and 2021. A small thing happened in 2020 called COVID. I don't know if you remember, it came to change our lives. The market, the economy was doing fantastic. But what happened? All of a sudden, COVID comes in, sends a shockwave through the markets. Everyone's at home. Everyone's ordering, their groceries online. Everyone's buying things on Amazon. I think a lot of us bought a lot of stuff during that period. And people also started to try to invest in other things, right? So when things started to go bad, people started to be afraid. What did the government do? The Fed? They decreased their interest rates to 0%. So all of a sudden, investors how are they gonna make up the 10% return that they're used to? They start to look for returns elsewhere. And they said, I'm gonna go invest into startups. So a lot more money gets pumped in. Then on top of that, you have the hedge funds. And then, I don't know if you remember, but we had a small thing happen, small, very big thing happened, the George Floyd murder. So on top of that, we had corporations start to support diverse founders, diverse managers, because diverse managers make up about less than 5% of all of the funding that is in the space. So all of a sudden you have even corporations pumping a lot more money. And similar to what happens with economies, inflation happened. When you start to pump a lot of money into the system, things just get a lot more expensive. So startups got very expensive. They started to amass very big amounts, large amounts of money. And the economy, same thing happened. We had inflation. So what happens next? Why did the bubble burst? Now the Fed had to react. And all of a sudden, interest rates go back from 0 to almost 6%. So now investors, they don't need to take as much risk to get to that 10% that they're looking for. So they stop investing in startups. And at the same time, what happens? You start to take less risk. A lot of these startups start losing their ways of funding, so less people are investing in them. And funds that have been launched during this time period disappear. So as a quick summary, very cheap money, created inflation, there's a lack of discipline, so everyone was competing for the same deals, companies raised too much money, there's very little diligence or research that is important in this space, and there's a lot of growth, a focus of growth at all costs. So now what's the outcome of this bubble bursting? Startup funding drops 30% in 2023. Zombie VCs, so VC funds that raised money during that time, they raised at the highest valuations ever. They're never going to be able to return money to their investors. So 38% of them have disappeared. Over 3,000 startups have shut down around the world. You've seen bankruptcies. I don't know if anyone remembers or knows about FTX, the crypto exchange. But yeah, this is what happens. The entire global, that hedge fund, they lost about $500 million in that investment loan, right? And just because they didn't do the diligence themselves, they didn't know what they were doing. So out of all this bad, a lot of good comes out. So now there's a reset in the market. Now venture capital is back to being disciplined, and it also creates a lot of opportunities for everyone. So basically it's, as I mentioned, there's a lot more discipline. Now it's an investor's market. Investors lead the terms. There are a lot of startups out there hungry for capital. It's more difficult to raise money. And I mean, some of you already know this. You've gone through this experience. And investors are the ones that dictate the terms. And if you're an investor, this is a good thing because it all sums up to better opportunities to buy low and sell high. At the end of the day, that's what the game is all about, right? Of course, yes, you want to support innovation, but as an investor, you want to buy the lowest valuation you can so you can make as much money later on. This is just a quick summary of investments have decreased in venture capital. Valuations have come down about 30%. We expect them to go down a little further over the next couple of years. And the time to raise money to graduate from one stage of investing to the next is increasing substantially as well. So basically, startups are having a much harder time now to raise, and investors, they get their pick of the lot. Now, going into the AI craze, and I'm just going to touch on this really quickly, but filling that void, when a lot of these venture capital firms disappear, and when there's so little money out there to be raised, big companies like Microsoft, AWS, NVIDIA, Google, they come in with their venture teams, and they're filling the void. So while AI, you had some investment in over the last few years. Last year was crazy. $23 billion pumped into an artificial intelligence, and half of this was Microsoft alone, right? So I'm not going to go into my thoughts about artificial intelligence. We can go into that a little bit later. But yeah, this to let you know that of the 10 top deals in the year, 2023, 4 of them had to do with artificial intelligence. and I expect that to continue. Whether it's successful or not, I have different opinions about that. Now, let's go into what, now that we've level set, now that we have a level playing field, let's talk about startup investing. So, as you already know, startups, you can't buy stocks from a startup on the open market. You have to do it through private placements. Basically, what does this mean? For startups, it just means I can get to choose who my investors are going to be, and those investors have to choose me. But I don't have to comply with a lot of regulatory requirements from the SEC. I don't have to be filing a lot of reports like their 10Qs, 10Ks. So it just makes it easier for startups to operate and not worry about the regulatory burdens while they're growing their company. So they can get their money faster, but at the same time, it's advantages for startups. Now you have more demanding buyers because you're high risk and you're not open to the market. So you have a smaller pool of investors. And at the same time, these investors, they want more. They're more demanding, they do a lot more research, and they want really high returns for the high risk that they're taking. So at the end of the day, that can also cause issues of growing at all costs mentality. Something you have to be very careful with. So who can invest in startups? So this is, I know a good amount of you are here to learn about this. And the quick answer is that almost all of you can invest in startups. But there are limits, and there are ways in which you can do it. So we have what are called accredited investors, and then non-accredited investors. Accredited investors are folks that can invest in any private placement that they want, whether it's venture capital, private equity, and they have to satisfy one requirement out of any of these. So they can either make $200,000 a year, $3,000 on a joint basis, or their net worth has to be $1 million individually or jointly, or they have some professional experience that deems them as knowledgeable, basically. So basically that they know what they're doing. Now, if you don't meet with any of these requirements, you can still invest in startups, and you can do it through crowdfunding platforms. And the SEC has actually created these regulations and has allowed certain amounts for you to be able to try out what it's like to invest in startups. So if your annual income is, or net worth is less than $124,000, you can invest a greater of $2,500 or 5% of, equivalent to your annual income or your net worth. If your net worth or annual income is higher than that, you can invest up to 10%, capped at $124,000 a year. So, with that said, why do people invest in startups? I already went through most of these, but some folks do it to diversify their portfolios. Some folks because they really believe in an idea. Maybe you have some expertise in the industry and you want to stay connected. Maybe some of you, I see a couple of professors here, you like the ideas of your students, so you want to support them. Maybe you have personal connections with some of these founders. And yes, tax benefits. So actually, the state of New Mexico just extended some tax benefits related to angel investing a couple of weeks ago. So more research on that. We can talk about that offline. But yeah, you get tax breaks as well if you invest in startups. Now, startups, typically when you're investing in startups, and what most of the focus of the rest of the presentation is, investing in startups at their very earliest stages. When they're coming up with a product, when they have barely an idea, when they're trying to figure out their business model, right? So startups have typically 3 phases of growth. First one is product market fit, where you're trying to figure out that business model. Second is scaling. So once you have that business model all set, how do you formalize? How do you create processes? How do you begin to really make a true business out of that? And finally, growth, where you're just focused on market share, just stealing market share for competition and growing. But where the interesting stuff happens for the most part is here, in stage 1, and where we'll spend most of our time. So these are the 4 ways in which we all can invest in venture capital and in startups. We can do it through crowdfunding platforms. We can do it as individual angel investors, through syndicates and venture capital funds. If all of these sound, they don't resonate, we'll go through each one of them, the pros, the cons, and what you should consider for each one. I won't consider in this presentation lines of credits or loans. But you can also loan money to startups so that they can expand, but I won't touch that. So crowdfunding. So I know most of you are probably familiar with non-investment crowdfunding platforms like Kickstarter or GoFundMe. Actually, one time, I don't know, maybe like 10 years ago, there was this company that was raising $100,000. They were creating these really cool boots. They were asking for about $100 per person. I sent my $100 because I thought I was going to get some cool boots down the line. The company wasn't ever able to reach the 100,000. I lost my $100. Woohoo! Too bad for me, right? And that happens quite a bit. So we're probably used to that. And the GoFund, basically to support and donate to a cause. But actually, now you have platforms that are focused on buying shares or buying into a startup. There are platforms like Republic, Start Engine, WeFunder. They're all different. There are others that have to do with real estate, etc. But basically, what these crowdfunding platforms do is that they pre-vet certain startups, the ones that they offer. They pre-vet them so that you as an investor, you're looking at companies that are serious. They're not scamming, basically. Right? They're serious companies that have serious potential, and well, you have to do the diligence, right? But what's really great about these platforms is that they offer educational resources. And they create communities, right? So you can meet other potential investors. You can research. They give you a lot of tools to research the companies that you might invest in. Of course, as in everything, there is some regulation, and there might be some limits as to how much you can invest or not, right? These platforms have different fees, whether administrative, whether per transaction, or they even charge you on success. So if you invest in a company here and you make $100, they'll probably take like 5 or 10. So things to consider when you're looking at crowdfunding platforms. Angel investment. Everyone hears about angel investment all the time. And for the most part, these are accredited investors, folks that are high net worth individuals that most of the time they've been entrepreneurs in the past, they've had success, or they have really good industry knowledge about what they're investing in. They can invest directly into companies because they know the founders, they have a personal connection, and maybe they do it through platforms because maybe their network isn't as big, to be able to do that direct investment. So they'll use angel platforms like AngelList, Gus, Cedar, Seed Invest, and many others to find a wider array of startups that they can invest in. These platforms, similar to the ones in crowdfunding, they'll offer different tools to background checks, financial analysis, legal reviews that you can buy on an extra basis. But basically, they help you vet as well. So they're all about supporting your process of investing into a potential startup. And some angels decide, I don't want to do this alone. I want to do this through a group. And actually, I know some folks here are members of angel groups. But basically, angel groups are folks of angels that get together on a regular basis to share their experiences, share potential companies to invest in, and they'll do it in many ways. It can either be through a fund that the group manages. They might just showcase different startups, and you might invest on a one-off basis. But each angel group is very different. Many of them focus on specific regions. Some of them focus on specific industries. Some of them even focus, they have a school affiliation. So hopefully we'll have one of those soon related to our university. But there are 200 angel groups across the United States with about 12,000 members. And the great thing about them is you get access to a wide variety of deal flow. Of course, it's specific to an industry or a region. And of course, to be part of these angel groups, there are fees associated to that, so things to consider, right? They might have membership fees, minimum co-investment amounts, or they'll even have requirements of, if you want to be part of this group, you have to invest at least $5,000 in startups on your own. So actually, before I leave this page, I do encourage you to go to the Angel Capital Association website to learn a little bit more about each one of these angel group firms. Syndicates, I don't want to spend too much time on here, but it's basically, it's a combination of investing into a fund or investing as an angel investor. What is a syndicate? Basically, you'll have a lead angel investor that does all the work. So while in angel groups you rely on the collective knowledge of everyone, and everyone looking for deals and bringing expertise, in syndicates it's only one person, and they'll invite people, potential investors, to be part of the syndicate, and they'll invest or not into these companies that these lead angels will bring forth. I won't spend too much time on there, but the activity is growing. This is just a heat map in regards to how venture funds, how companies, how angel groups are starting to make and develop relationships amongst themselves to spread the risk and to invest into these syndicates. Now, this is where I want to spend a little bit more time. And I think as you're thinking about investing into any type of private placement, you have to think about the diligence, the research that you have to do in each one of these categories, whether you're investing directly into the startups, or if you're going to do it through one of these platforms, or even into a venture fund like mine. Now, and this also goes to a lot of the founders here. So this is what your investors are going to be thinking about, right? So when you're thinking about launching a business, when you're looking for investors, the first thing that your investors are going to look for, they're going to analyze the team. They're going to analyze who's leading the charge. They're looking for folks that have good leadership, that can inspire other folks. Especially, how can you go out into the market and convince people to give you some of their money, hard-earned money, to launch a new idea, and that you can execute. So typically, they'll be looking at experience. Have you been in the industry before? What's your track record? The commitment that you have to this. Are you doing this full time? Are you doing this on a part-time basis? What's the effort that you've put into the startup so far, right? Have you been doing this on your own? Do you have help? How much money have you put into this? All these things are really important. It gives signal to investors about how well you can deal with change and with difficulties. Flexibility, this is probably one of the most important things related to leadership. Because as we already saw, 80% of startups disappear in the first 5 years. So to survive, most startups, they pivot. They end up doing something completely different. So you have to be flexible, and you have to be able to take feedback. And finally, determination. So do you have the grit to be able to get through the tough times? Market opportunity. This is basically analyzing, can the startup compete in this market? Is there an actual market where you can actually compete and grow? If it's a market of less than $1 billion, for the most part, I would tell you, most investors will not even look at it, right? So just off the bat. You have to think about the market dynamics. Is it a market that's growing? Are you looking to reinvigorate that market with your solution? Is this a new market? Are you going to create something new, completely new? Now, is there an actual problem or a need worth solving? So think about Coca-Cola, New Coke. I don't know if you remember that in the 1990s. It was the solution that no one was asking for, and it was a complete fiasco, right? So, are you building something that people actually want? Is there an actual problem? And, yeah, what is your product, right? So, is your product, what is the degree of innovation of your product or service? Is it a better mousetrap? Something that you can maybe build a small business around it, but not a lot of growth. Is it material innovation within the industry? Can it define an industry? For example, play like Airbnb or some of these big companies that end up being huge IPO successes. I would say that the majority of startups end up being material innovation for the most part, and they get acquired by a bigger guy, right? So 80% of startups, they end up being this. And that's good. Business model. So yeah, you found out that you have a good market opportunity. How are you going to make money? And is there a path to profitability, right? So is your solution different? What is your value proposition? How are you actually going to deliver this product? How are you going to address, how are you going to find these customers? Who are your initial customers going to be? And does it make sense to acquire these customers? So if it costs me $10 to acquire this customer, over time, if that customer is only going to give me $5, it makes no sense to invest in that. And of course, over time, I mean, startups, they're never profitable at first. They'll lose money, but they show a path, a growth path. So you have to show a path to profitability. And what's the exit strategy? I mean, similar to what we were mentioning in the previous slide, do you want to be that IPO company, or are you trying to become this solution that gets later acquired maybe by a big competitor? Competitive landscape, things happen, right? So a lot of the big players that you might be competing with, can they take you out of business really quick? How are you going to respond to that? How much money do you need to be able to respond and to survive? And is what you're doing, replicable, right? If competitors can do this really quickly with very little effort, maybe it's not worth, pursuing this initiative. Financials and traction. Basically, what is the demand? So most startups, they won't have any revenue, they won't have any money, but what's the interest? So maybe you have a landing page where you have 2,000 people on the wait list to get your product or your service. That sends a really good signal to investors that there might be something interesting here. If you do have a customer, what's their feedback? Do they love it? Is it sticky? If you have clients, have any left? And if so, what? How much money are you going through on a monthly basis? How much money are you burning? And how much money do you have left to operate on a status quo? So looking at this, you also have to, as an investor, why are these folks asking for so much money? So if you have a minimal viable product and you have very little revenue, you can go out to the market and ask investors for $5 million, right? It makes no sense. So you have to show, why am I worth a certain value, right? How much is my product and my idea worth? And that's what investors are going to be looking at, right? Are your projections, are they realistic? And of course, how are you going to use the money that you get them? Finally, risks and unknowns. For the most part, I mean, we can't know everything. We can't mitigate everything. And of course, we already saw startup land is very risky. 80% of these startups disappear quickly. But you have to consider what are the macroeconomic conditions, politics, how do they play? What happens if one of your founders passes away, or if they leave the company, or if they have a personal issue? How is the company going to survive? So we have to have plans around all of this. Now, when you're thinking about these investing platforms, you also have to diligence these platforms. Several things that you have to think about. So, do they have cool tools for you to become a better investor? I mean, if you're in your initial stages of becoming an investor, going into the startup world, do these platforms help you? Do they give you information? Do they create community? Do they give you data or the possibility to request more data from the startups that you're analyzing? The investment focus and process. So the same way that you might want to choose, or the same way that you choose startups that you like and that you would like to invest in, the startups, they also choose you. So they might want to, some startups, they don't want to work with you, right? And that's totally fine, because maybe you don't align on values, you don't align on business ideas. So what's the process of investing into these startups? So every platform has a different process, and every startup has a different minimum, or they might just do it through invitation only. What industries are you comfortable with, and where are the amounts of money that you're willing to lose, basically. Fee structure, fees, always look at the fees. So I'm going to skip over that. Community, do these platforms allow you, of course, to become that better investor? Do they create community opportunities for you to learn, webinars, events, and are they included in those fees? Because a lot of these platforms, they might charge you additional money just to be able to have access. You want these platforms to comply with all the regulations. So please research, do they comply with the SEC? Make sure that they're not a scam. What is the customer service like? What is the experience? If you have questions, are they going to help you? Or are you just going to be left there to the dry to figure it all out? And finally, maybe one of the most important things after compliance is what's the quality of deals? A lot of the big successful companies, they might not be on these platforms. There might be some great opportunities, but some others might not be on them. and that's okay. But look at what has been the success rate of this platform in creating and funding successful startups, right? So think about the quality. Now finally, before I go into questions, gonna go into funds, venture capital funds like mine. Basically what we do is we take away for a larger fee, basically. We do all the work that I mentioned earlier, we do that for investors. That's basically what we do. We have a specific type of investment. You might focus in the early stage, and we went through the stages earlier. You might be in the early stage or medium stage or on the growth stage. We have a specific strategy. Maybe it's focused on an industry. Maybe it's focused on a region. For example, my focus is on the Southwest and on cross-border initiatives. They have specific ways of finding companies. We have a differential way as to how we find companies. Maybe it's because of the network that we have. Maybe it's because we use certain algorithms to find out where companies might come, might appear very soon. We might just have a really great network of co-investors that we share deal flow with. But basically what do venture capitalists do? Every couple of years, they raise a fund. They raise money from high net worth individuals, from endowments, from universities, to go out into the world, find these interesting startups, invest in them, monitor them, and hopefully get them to a potential exit where you make money and everyone is happy. Of course, it's easier said than done. It's a very difficult arena to participate in. But this is what we typically do. For example, in our case, I collaborate very closely with a lot of these names, a lot of these very known venture capital firms like Koshla, Sequoia, Axel, 16Z. I have very close relationships with a lot of these folks, and we share deal flow, right? And a lot of times we co-invest and we help each other. So it's a very collaborative community for the most part. And what do we do, right? I mean, yeah, we go out into the world, we find these interesting companies, we invest in them, but the real focus is, how do we support them in making their business model really work, right? Some VCs have a very, you could call it passive role, where they just invest. There are other VCs that take a very active role, right? For the most part, VCs are there to support they're there to support with growing your strategy, right? With how do you find those first clients? How do you find those first hires? How do you avoid the common pitfalls of a startup, right? So that's typically what venture capitalists do. They either have experiences as former operators or founders. In my case, I'm a former operator. There's some folks that just have pattern recognition, or they've been investors for a long time, so they understand certain industries very well. And for the most part, they all have a very large network, right? But basically what venture capitalists do is that they provide guidance for the most part, and to all these startups to help them grow and reach their next stage of financing. Now, when you're analyzing these venture funds, you have to analyze their investment philosophy. What do they care about? The team, same way that you analyze, who the, when you're investing in startups, you also analyze the team of a venture fund. Have they done this before? Do they have a complementary skill set? Do they work together very well? Are they good to execute the strategy that they've set out? Track record, very important. Have they helped firms before grow, either as operators or investors? What are their values? I think this is actually very important. So there are a lot of successful investors out there, but you have to think about, how they carry themselves on a personal and on a business manner, because typically the way that people conduct themselves on a personal level, that's how they conduct their businesses. How do they communicate with other folks? How do they collaborate in the industry? And what makes them different, right? So, as Dr. Wilson mentioned, money is money, right? People want to get money however they can, but aside from money, what can fund managers do? Can they help these startups with industry expertise, with operational experience? Have they gone through the issues, right? Have they gone through the problems that these startups have gone through or that they're going to be going through? And how can they support these startups through the journey? Quickly, pros and cons. I'm going to send this over to you, but there's a summary of all the different types of ways that you can invest into startups, the pros, the cons, the fees that you have to consider. And hopefully this will be a good way for you to begin your journey of investing into startups. Some quick takeaways: startup investing is very high risk. There's potential for high returns. You have options to invest in these startups, maybe with limits. Each option has its own goods and bads. You have to do due diligence before you have to do your research. Basically, do your work before you make any decisions. And really cool for those of us that are maybe older, you might already be invested in startups or venture capital funds through your 401ks, pensions, etc. So actually, the university, for example, even is managed. Its financial resources are managed by UTIMCO, a very large fund. They have, I believe, 4 different funds. One of them is for operational resources to fund school operations, and others, to generate potential for growth. And of course, before you make any investments, consult your professional advisor. And with that, I'm going to open it to questions, whether it's about investing, whether it's about startup land. Happy to spend some time. And I know that was a lot of information, but I had to run through it. Hopefully this is helpful. Any questions, whether it's online or here? Yes.
First of all, thank you so much for the presentation. It's very insightful. Can you describe the strategy that you have in your VC fund when it comes to the current macroeconomic environment where you're facing and interest rates? What's the strategy that you guys are taking?
Sure. So when it comes to mine, our focus is, we're regional, so our focus is on startups, early stage startups from the Southwest Mountain region and cross-border. So I'd say, for the most part, we're not worried about interest rates. For the most part, we're just focused on finding great founders, wherever they are, connecting with them early on, and hopefully being their first institutional check. Now, our strategy, we're going to be investing, our check sizes are going to be about $250,000. So that's not leading around. We're not leading rounds. So what's good about that is that we're very flexible. We're able to really collaborate with a lot of these bigger funds. So even local funds or funds that operate throughout the state, it's cool because we get to share deals and we can go in it together. Yes.
What do you think is the best way to reach out to VCs as a founder?
Yeah, so the best way to read, and great question. So it takes a while for folks to respond, and I'll tell you, I get a lot of emails. But the best part is send them an email. Either reach out also through the company's website. But even better if you can get a warm introduction. So if there's someone in your network that knows that potential investor, get them to make that introduction. It's easier. Like it definitely cuts the time to connect with them maybe by half. Yes.
What are some of the challenges in investing in startups in the Southwest in comparison to, startups in Silicon Valley or in Austin?
Actually, not as much. I mean, yes, they're different ecosystems, but founders from the region are actually a lot of times better equipped than some of the folks on the coast because they do a lot more with a lot less. So they tend to be grittier, they bootstrap. They're great ideas. I think maybe what you run into sometimes is they might lack a little bit of confidence, but they can do great, and they can compete. So I'd say more than anything, focus on your delivery and your presentation. Yes?
Can you tell us, I don't know if you did, a little bit about your background, like what education you got and stuff like that?
Sure, yeah. I mean, I didn't want to spend too much time there because maybe a little bit more on the boring side, but my background, after graduating from UTEP, I started my career in investment banking, focused on the technology side, so I invested in technology companies. So it's a lot of information, right? Yeah. So I started my career in JP Morgan, focused on technology investments. Actually, I worked on Facebook's IPO in 2012. So that's probably the only time I ever had fun in investment banking. And I didn't sleep at all, right? So I did that, then was approached by Bloomberg, which you might know as a large financial technology company. There I worked under Mike Bloomberg's chief of staff. So reporting to, I was there for about 4 years, doing several things. I did a lot of M&A, so I did joint ventures, so purchased companies, integrated them into Bloomberg. I did a lot of joint ventures. I also launched new innovations for Bloomberg. So anything related to blockchain technology, I was in charge of that and integrated that technology into the offerings that the company had. From there, I got my MBA at Harvard Business School. And since then, I've been an operator, both in large organizations and small. Most recently, I was CFO of a fintech startup called Eagle. The company was an invoice management platform in Mexico. We expanded to other countries. I raised about $100 million during that time. I started off as employee number 13, where I launched product. So I was in charge of launching the product itself, building all the infrastructure behind it, the legal framework. Became CFO. I was able to raise our Series A and our Series B from very large companies. And right now, the process of selling the company too. So excited about that. So sorry, I didn't want to spend too much time there because we had a lot of information. Yeah. Yes.
Do you have recommendations for the students, like wealthier students?
Oh God, I think that the best thing to do is, I say 3 things. One is join a student organization. I think that gives you an opportunity to learn about what you like, what you don't like. Maybe try several of them out to see if there's something particular that you didn't know about. Number 2, learn how to network. I know a lot of people don't like networking, but think of it instead of labor or work, think of it as an act of service. So it's about connecting with people, about how can I help others in their journey. And maybe you'll find someone that can help you throughout yours. And finally, I'd say look for mentors. Look for mentors. And there are actually now some resources that are being developed on campus, even at the College of Business. But maybe informally, send cold emails and send cold LinkedIn requests. Because for the most part, when you're a student, gosh, people want to help you. I mean, if you're young and you're hungry, I'd say 80% of the time, folks are going to reply on LinkedIn. The other 20, too bad, they're lost, but reach out. Look for mentors and folks that you can connect with. Yeah. Yes.
So in a prior conversation,
Oh, sorry.
you shared data you shared data before and your inspiration for investing in our region. Can you talk a little bit about that?
Sure. Yeah. I'll quick highlight, but for the most part, we've seen that a few things have happened in the region, and why we believe that the Southwest is an important region for us to consider. And one of them is that today, about 85% of the capital invested in startups goes to the coast. Most of that goes to Silicon Valley, it goes to New York, it goes to Boston. But that capital tends to be very inefficient for the most part. So a lot of great companies, right? But there's also a lot of fluff. So sadly, that 85% of the money only develops about 60% of the unicorns, of the really successful startups. So that goes to tell you that there's arbitrage. There's opportunity to find, these great companies in the rest of the United States, and we believe in the region because of the tailwinds that we have in certain industries. So things related to logistics, things related to healthcare, or we're looking at financial technology, especially thinking of the diverse population that we have. So we have looking at the Southwest region, about 40% of the population is Hispanic or diverse, and it's underserved in many ways. So a lot of opportunities there. So just as a quick highlight, that's what I would say. There's a lot of opportunity there. A lot of great founders, as I mentioned, folks that can do a lot more with a lot less. And actually, as an investor, and this is on the for my benefit, right? But valuations tend to be lower in the region as well, right? So about 15-20% lower than the national average. Yes. Sorry.
So when you're in the process of doing due diligence, what do you consider to be like the 3 most important things?
For me, and honestly, the most important thing for me, the number one, is the founder. is the number one. You know, is this someone that I can have a relationship with for the next 10 years? Is it someone that can execute and that cares deeply about their product or their idea, and that they can take feedback? I mean, you don't always end up, you know, where you thought you were going to end up. You have a different idea. Things happen. Things change. So, team is my biggest focus. The other things that I care about are more confirmatory, or just thinking more about typical business sense. I look at financials and all that, but the most important thing is the team and the founder. Yeah.
So,
all right. We have a founder here. Which, congratulations on the recent raise.
Well, there's another one, so.
There we go.
What's the plan of going for check, and do you have any targets in mind?
Yes, so, so I've spent, I mean, we're fairly, I mean, I started fundraising in October of last year, and we're hoping to be able to put out our first checks in probably middle of Q2, is my guess. So end of Q1, middle of Q2. We have a lot of targets, so I've spent about 50% of my time fundraising, invested 50% of my time on the fundraising, another 30% looking at startups, meeting great founders to prove out that there's talent. And believe me, there's a lot of talent in the region. And also, I mean, I have a very large cross-border focus as well. So I'm meeting tons of great investors from the region. So I'm sorry, founders from the region. So yeah, I definitely have targets, folks that I would like to invest in. Yeah.
So as students, like, what are some of those ways we can get to learn more about the VC environment and all that? Besides just reading the internet, any programs to share, something useful?
Oh God, so I think there's actually a lot of collective knowledge in this room, and I'm excited. There's so many people I want to mention. But starting off with UTEP and the Michael Lewis Center, Studio G, the Launchpad. Starting there, a lot of great resources for students. There are professors here as well, and they care about entrepreneurship, so reaching out to them. Pioneers 21 is also here in the room. They have fantastic resources when it comes to supporting folks that are launching their business, even thinking about their website, even thinking about online marketing. There are angel investors here, so they can also be a wealth of knowledge, right? You know, I don't want you guys to raise your hands, but I see a few of you here. I don't want to point you out because then you're going to have a long line of people. Right? I'd say that. And what else I'm forgetting? There are folks here that represent angel groups as well. So some of them even have educational resources that you don't necessarily have to pay for. So that's also another way to learn, right? So there are a lot of resources that you can leverage, and I'm happy also to have a conversation, and maybe that's a good thing. I should maybe put some resources on our webpage, borderventures.com. I could put some resources there to people that you can reach out to learn more about. Yes.
This is kind of a two-part question, but how do you determine the size of a fund you want to raise, and with that, you kind of have an idea of the kind of check size you want to write. How do you determine the number of capital you want to save for follow-on investments so you don't get diluted too much for the exits when you start?
Awesome. So we're going to get into some technical questions here, but great question. So I think when you're a venture fund, your size is your strategy. That's it, right? If you want to have a large fund and compete against some of the gorillas in the space, I mean, go for it, you know? So, a lot of, too many. So you have to have a mix of companies that will give you better chances of being successful, but also be able to have good ownership on the onset, right? So you don't want to pay a large amount of money for very, very little equity that's going to get diluted in further rounds. But at the same time, you don't want to invest too much money that you have very little money to invest in just a few companies. So for the most part, I'd say on average, the majority of venture funds, they'll invest in maybe 25 companies. Others will invest in maybe up to 40, and that's fine, just to give themselves better chances of success right? In my case, I mean, I'm looking to invest in about 20, 25 companies and leave that, with a check size of 250, that leaves me about $1.5 million, $2 million to invest in follow-on rounds, right? That I can continue to support these founders in their next stage of growth. Of course, also being mindful that you already know that out of 20 companies that on average folks invest in, 15 disappear really early on. 3 of them will limp along and make some money, and then 1 or 2, maybe 3 are the ones that will give you any profits at the end. Yeah, hope that helps. I mean, you know a lot about this, but that's the way that I think. Yeah. Yes.
So you keep throwing this number 250,000 around. That's something that I'm going to have a discussion with you outside of this. But why 250? Why not 249,999? Why not 100,000?
I like round numbers. That's it. I like round numbers, but also, and it goes back to Max's question around ownership. So I already mentioned that when it comes to my strategy, if we're focused in the Southwest and in cross-border for all of Latin American startups, valuations are lower than the national average. Sometimes by magnitude up to like 25%. It happens sometimes. So that allows me to buy, over 5% of the company early on, and not get too diluted later on. So I like 250. Doesn't have to be that 250. It might change depending on the company, but I like round numbers.
Okay.
Would you have to be like as a team partner, like as a startup, before you look for like investors, like having a team, a business plan, a website?
Oh, okay. You're looking for investors. Well, that's another thing I didn't mention, but most folks that are starting their companies early on, you're looking for friends and family, people that believe in you early on, just to build a prototype or to build an idea, right? What is the lowest cost way that you can deliver your product or service? So I don't know if anyone here is familiar with Rent the Runway or what's it called? Zappos, is that the one with the shoes? Mm-hmm. Yeah. So the way that Zappos launched, they didn't buy inventory. What they did is that they put up a website. They put up, these are the models that we're going to offer. And if people actually wanted to buy them, then they would go and actually buy the shoe and ship it to you. So don't necessarily offer the solution, the whole grand scheme, the solution, the whole idea. What's the cheapest way to offer something similar? And based on that, create interest. And based on that, you create some traction, and you can raise investment. I know some folks here might have different ideas, but thank you so much. Thank you so much. Happy to spend some more time after this.
And hopefully you can stay here and network with everyone in the room. We have Pioneers 21. We have founders here. We have Chelsea, and we have Marco, and we have faculty as well that are interested. We have Max in the back that's an angel investor as well. So there's plenty, as you were saying, there's plenty of, there's plenty of information and network right now. So I'll let you all to network with this group. STTE as well. Thank you. And just so you know, we're going to be providing you the slides, contact information, and I have another slide here. Yay. All right, so if you are ready to take the next step and then you say, okay, I'm ready, I have a wealth of knowledge right now. As I was saying, Magnolia Center for Innovation and Commerce, we're here to connect you with different individuals across the El Paso community. Make sure that you visit us. We're in Prospect Hall. This is it's a quick way to know where to find us. Make sure to follow us on social media and, of course, our website, where we'll be uploading these presentations and further conversations with more people like Alejandro. Also, if you're ready to take into the next challenge, there you go, perfect. Now we have a pitch competition coming up on April where we are going to be providing up to $5,000 in cash for the first place. So hopefully you are very excited and ready to take action and start presenting your idea in this pitch competition. Applications are going to be opening next week. So we're happy to provide you with more details, and we're happy to answer any questions that you may have after this event. Make sure to follow us, and thank you for being here.